US CPI inflation data was just released. What does it show for the current state of inflation in the US and where it might be headed? So, CPI inflation came out today, and we can see here in white CPI, this is a year over year number. We can see it came in exactly in line at 2.4. The expectation was 2.4. Here, I also have the 5 year break even. This is the difference between the 5 year Treasury yield and the 5 year TIPS, which is an inflation protected security issued by the Treasury. And then the 5 year forward, that is looking a little bit further out, basically from years 6 to 10. What does the market expect inflation to be? And we can see that in general, this is trading exactly right near the Fed's target of 2%. And it has been on a very clear disinflationary trend. That trend seems to be continuing. I will point out this, though. This is the University of Michigan inflation expectations. This is a survey that's released. The University of Michigan conducts this survey where they call a sample of Americans and ask them about their expected what they expect inflation to be. And we can see a huge divergence. I've been pointing this out for a while, but as of the last reading, that expectation is 6.5%. Meanwhile, this has happened at the exact time that inflation has actually been slowing. This is called disinflation. Prices are still going up so long as the white number is positive, so long as CPI is a positive number, not negative. That does mean that prices are going up. It just refers to the rate at which prices are going up. So the white line CPI, when you hear this number, it is not the kind of cumulative inflation. This is more so the year over year change or the rate of change of prices. And clearly we can see, it hit a peak during 2022 of that 9% and has been falling ever since. Here's core CPI. So core CPI takes out food and energy. And that was expected. The Wall Street expectation was 2.9%. But this actually beat expectations and came in lower than expected at 2.8% year over year. And the reason that they subtract, the reason we have these core numbers is because food and energy can be very volatile, as we will look at here. So here is just a general kind of correlation that you can see between WTI crude oil and the CPI year over year. We can see that crude actually started to move before CPI. After the events of 2020 and the money printing and all of that, clearly crude went negative, or at least futures went negative. And then crude started to rip higher before inflation, kind of foreseeing that inflation. But hopefully the correlation here is clear. This CPI measure, just kind of the headline CPI measure, that does include food and energy. And so you can see the correlation between the price of oil, which is an input for basically everything nowadays. This price of oil is extremely important. So if you have a view on oil moving higher, then it would make sense to have expectations of higher inflation. But I will just note, the red line shows this has been inflation has been falling since June of 2022. That was the peak in the rate of inflation at about 9%. Ever since then, it has been falling. I'll say, since the inauguration, this is something that Trump likes to talk about. Since the inauguration, CPI is down from about 3% down to 2.4%. A lot of this has to do with oil, and a large reason that oil is down is on lower growth expectations. So this is kind of the other side to that coin. You have the World Bank coming out recently, I think it was yesterday, revising their global growth forecast down. When you slow growth, that also slows inflation. So there are kind of two sides to every coin. A lot of times inflation, I mean, remember, inflation is one of the inputs for nominal growth. And so, if you enact kind of, policies that could inhibit growth or slow down growth, that will also slow down inflation. So this was part of the reason that inflation was such a problem for 2021, 2022, why it was moving so much higher was we were printing so much money. There were also supply constraints. But the rebound. Remember the rebound in nominal growth, the rebound in nominal GDP was very robust. We kind of, we were very worried, or the government was very worried about going into a very dark recession, and so they kind of overstimulated. They erred more on the side of overstimulation, and we actually had really strong growth coming out of kind of that initial phase. Well, the other side to that is higher inflation. To get strong growth without inflation is much more difficult. And so I think that that's the other thing to point out. Here is food inflation. So the red number is just the overall headline number that does include food and energy, and then in white is just food inflation. And we can see that they've been moving roughly in line. Food inflation was actually kind of running hotter even before kind of the big spike in CPI. We can see here in late 2020, food inflation moved higher to 4.5%. Meanwhile, CPI was printing, almost zero, showing deflation, and has been sustained higher. Those have come much better into balance, but we do see food inflation moving lower from, called an all-time low here of about 2.15%. We do see food inflation ticking up over the past 9 months or so, and is currently at 2.9%. Now, remember, food and energy are kind of the two main components of what a normal person will need. You need food, you need energy, you also need housing, and so that is another huge component. Here is nominal growth, just kind of an update on nominal growth. So 4.4 is nominal growth. Remember, this is nominal GDP. This includes inflation. And as of the last, real GDP, you add that to inflation, and you get 4.4, 4.3. And I just want to point out yet again that bond yields are higher than that. Now, the 5 year is currently a bit lower, but just ever so slightly. The longer bonds have moved higher, have moved above nominal growth. The 30 years, right up there at 5%, and the 10-year yield is at 445, right about 450. This is a positive. This makes the debt burden for the U.S. more difficult, and could start to cause problems if bond yields continue to move higher and if nominal growth continues to weaken. One of the downsides of falling inflation, right? If CPI continues to fall and real growth, real GDP, just goes sideways, well, that falling inflation will take this nominal growth number even lower. So you don't want too much if you're the government, at least, you don't want too much disinflation, because in that case, bond yield, the spread between bond yields, or the cost of interest on the debt, and your economy's kind of economic output, that gap gets wider. And when bond yields, or the cost of the debt, move above nominal growth, and that spread widens or increases, that makes the debt burden that much more difficult. And we can see that, generally speaking, I mean, this goes back to 2011. Generally speaking, bond yields have been lower than nominal growth. But I keep pointing out the kind of direction of travel here. Bond yields have been moving higher for the past 4 or 5 years. Nominal growth has been falling. I mean, this is a pretty clear trend going back, 4 or 5 years. If this continues and we do not see kind of a reacceleration in nominal growth, and bond yields just kind of keep grinding higher, this could start to cause some issues for the government. And so I think this is something to continue to keep an eye on. Here we have CPI, the inflation, Consumer Price Index inflation. We can see this on a month-over-month basis. This shows the degree to the rate of increase that prices are increasing, that rate of change on a month over month basis. We can see that here in May of 2024, we had a slight negative print, meaning month over month prices actually fell. And then we can see here again in March of this year, prices also very, very minorly fell. And the expectation for month over month CPI was actually 0.2, and inflation on a month over month basis came down slightly lower at 0.1. There's a ton of noise in kind of month over month data, and certainly, again, as I said, I think one or two videos ago, anytime you see people trying to extrapolate out a month over month and annualizing this month over month number, I would be very, very careful. So here's gold. Here's kind of the other side of inflation, I guess we could talk about. Before we're looking at CPI. Well, CPI, this is the Consumer Price Index. This is a basket that is created by the government, and it's constantly modified. And they constantly do substitutions where they go, well, the price of a ribeye steak is up 15% the past year. But the price of ground beef, that's only up 3%. Well, it's basically the same thing. People don't need an actual steak. They can just eat ground beef. It's really the same thing. And so they will substitute out that ribeye, which is up 15%. They will take that out and they will put in ground beef into the basket, to the equation, and it'll show a lower number. Now, OER is another kind of very widely talked about one of these kind of adjustments that they make where this is not the best measure. I think most people can agree on the actual cost of housing. If you measure the actual cost of housing the way I, as a young person who would like to buy a house, I have to go qualify for a mortgage. That mortgage will have an interest rate, which is directly tied to bond yields. And then, there will be a monthly payment. And you can calculate that very easily. We have nationwide housing data, right? The sales price of an average home or a median home. But they don't do it that way. They use this kind of owner's equivalent rent. So there's all sorts of kind of adjustments. Now, some of those adjustments are needed. The equation in 1980, people weren't buying many iPhones. Right now, people are buying iPhones. iPhones didn't even exist back then. So there are certain changes. I think to say that the basket should be identical to what it was in 1980 is incorrect. I think that extreme is incorrect. But I also think that the current numbers do understate actual inflation. And so now we're going to look at asset price inflation. So here we have gold, and this goes back to July of 2019, the summer of 2019, before all the crises of 2020, before all of that. And we're looking at gold, the dollar price for an ounce of gold. We're looking at M2 money supply. We're looking at housing. This is the average single family home price. And then we're looking at the SPX. And we can see that, generally speaking, gold kind of moved first. It increased, right, was able to kind of anticipate this increase, this dramatic increase in the money supply. And this came, as a result of kind of the stimulus and all of that. But look at the general kind of where everything settles out by 2022. You have gold that's hanging out around 35 to 40%, kind of in this range here. This is one scale. You have the average single family home price up about the same, about 35%. You have the money supply, which at its peak increased about 47% from July of 2019. And the S&P, which at its peak kind of overshot a bit, up to 65% return in this period of time, but ended up coming back during the correction of 2022. Now, markets generally overshoot to the upside and they overshoot to the downside. We can see this with gold, right? It kind of overshot to the upside, ended up having a correction, coming back much more in line with S&P and money supply growth. And so markets do this, And of course, the equity market has other considerations with it, price to earnings. You're talking about companies. What are their margins? What are their margins doing? What's expected for the future, when it comes to those margins and those cash flows. So I'm not trying to make this a hard and fast rule, but it is kind of interesting to me that they all settle right around the same, which is, the money supply increased about 40%. We printed 40% of all the money ever created in the history of the US. We created 40% of that just in that period of time, from 2020 to 2022. That cannot be understated, the effect that has on asset prices. So asset price inflation is a totally different thing. And I would argue some people have been pointing out that when it comes to the money supply, that it's not 100%, super accurate way to measure inflation, and I agree. So here's the thing: there as the economy has become more kind of hyper financialized, you have kind of two emergent markets, I guess you could say. You have asset markets, which, remember, that are vastly disproportionately owned by the top 1%, top 10%, certainly. You have asset prices like homes, real estate, stocks, those sorts of things. But then you have, food at the grocery store, and you have auto insurance, and those types of things that kind of everyone needs. Well, I would argue that asset price inflation is just as important as consumer price inflation, right? Because when you talk about building wealth, when you talk about the American dream and the middle class in America, what is that? Well, the traditional kind of iteration of this was, you buy a house. Buying a house is the best way to build wealth, right? If you are a lower middle class, working class, buy a house, you save up for down payment, buy a house, and then that house will build wealth. Well, what's really going on there? We've looked at this many times, but if you take the gold price for an average single family home, it's actually near record affordability levels. So that increase in the sales price of a U.S. house is really not that the actual value in real terms is increasing. It is just, again, going to the last video we did, kind of an optical illusion, right? It is no coincidence that the money supply increased by 40% during this kind of 2020, 2021 money printing bonanza, increased by 40%. And what was the nationwide single family home price increase? 40%. These things are not, coincidence. And we can see the correlation with all of these kind of asset price inflation that we can see here. Really, at the end of the day, what a house is, the reason it's building wealth, as the kind of traditional narrative goes, is not that the house is getting more valuable. What a house really is for that working class person, that young family, is levered exposure to currency debasement. Housing does not, appreciate in real terms. And a lot of people that are in the real estate business will point this out. They go, look, housing is not an appreciating investment, right? Like, the house gets older. And require, or the roof goes bad, right? Plumbing and electrical. The house gets older, and if anything, it's a depreciating asset. So why does the U.S. dollar price of housing go up? Well, it's because people use housing as a way to protect their purchasing power, as a way to preserve their purchasing power, and as a store of value. Now, a house shouldn't be a store of value. A house should be a thing that you live in to raise a family in. But unfortunately, given kind of the structure of our system and this kind of structural inflation, that is what housing has become. And this has existed for a long time. Go back to like the land banking concept of the 17 to 1800s. This is not a new phenomenon, but this asset price inflation is important, right? If you're someone like me who's in their early 30s, worked really hard for 15, 16, 17 years up the corporate ladder to one day achieve that kind of American dream, and I would have to triple my six-figure salary in order to afford a house in anywhere near kind of where I currently am. Asset price inflation certainly matters to someone like me. And the same thing is true for the S&P 500, right? Like, if young people cannot invest, if wages are not keeping up, if assets are outpacing wages, as we know they are, to a stunning degree, then they are not able to participate in the wealth creation of the kind of modern day American capitalist structure of this, of the system. So I think that asset price inflation, while it is correct that it is not consumer price inflation, it is just as meaningful. If you were someone my parents' age, they were able to participate in one of the biggest bull markets. I mean, you could throw a dart at 100 different tickers on a dartboard, close your eyes, throw a dart, and the thing went up like 14,000%. Being able to participate in saving and building wealth in whether it's levered exposure to currency debasement through a house, or whether it's participating in something like the equity market, these things do matter. And so when asset price inflation, yes, it is different from consumer price inflation, but it's, in my opinion, for young people especially, equally important that asset prices are running away from wages to a stunning degree. So here's the other thing I wanted to point out. Here's gold. I've been talking about this for, I don't know, a year and a half. This run up in gold. Now, people also have issues with using gold to try to estimate kind of purchasing power or as a measuring stick. I agree that it's not a perfect measuring stick, but I do think it's the best neutral measuring stick that we do have. When there is a supply and demand imbalance with gold, right? Gold has been money for hundreds, if not thousands of years. It has been the pinnacle store of value up until, recently with kind of more modern takes on gold, right? But like generally speaking, gold was the pinnacle of wealth preservation, store of value, and money. It was the base layer for money. And so when you have gold running up, that does indicate some people have been talking about, well, it really means there's a supply demand imbalance. And I go, yeah, no, 100%. That's exactly the point. There is a supply and demand imbalance because the supply of money and the demand for a way to preserve purchasing power. You if you're a wealthy individual, you want to keep your wealth, right? If you built wealth over a decade or two, or you inherited it, you want to keep it. You don't want to lose it. So if there's a huge wave of money printing about to happen or currently happening, you are going to seek investments that preserve your purchasing power. So when the supply of monetary units is dramatically increasing, and there's only so much gold, right? Gold has scarcity. There's only so much gold. That new increased supply of monetary units trying to buy the same kind of scarce amount of gold, that will cause the price to go up. So yes, it is a supply demand imbalance, but that's kind of entirely the point. There is an excess, right? The reason the price goes up is that there is an excess of monetary units, currency, fiat currency units, and only so much of gold. And then so I think that this run up over the past, it really started in 2022, 2023, this breakout here. I think that the fact that it's run up from, call it 2000 at the breakout here in November of 23, all the way up to 3,300. I mean, that is a dramatic increase in the price of gold just in a relatively short period of time. I mean, that's 70% increase in the price of gold. A lot of times, right, we know central banks are buying gold. I think given the kind of over leveraged situation that most developed nations find themselves in, the central banks have been smart to start to buy gold. On a net basis, central banks have been accumulating gold, and I think that the smart money, I guess you could say, the central bankers. I think they know where things are headed. They know that the developed world is over leveraged on a sovereign level. They know that there's really no way out other than to inflate the debt away, to devalue the debt in real terms. And I think that is one of the reasons that central banks on net started to buy gold 8, 9, 10 years ago, right? During QE2 and 3, when the US was coming out of 2008 and basically printing over $1 trillion after the 2008 recovery. This was kind of, years after, 2, 3 years after the heart of the GFC. They continue to print kind of insane sums of money through the quantitative easing programs, and that's really when the central banks started to buy. That's when the trend started to reverse and they started to buy. But I think, investors all over the world are seeing what this is telling us is that money, because remember, markets are forward looking instruments. This is forecasting a loss of the purchasing power, the real purchasing power of the dollar. This is the gold USD. We can also look at it. The same is true. This is, an expectation of the gold market for the degree of purchasing power for the euro. You can look at the Chinese yuan. At the end of the day, that is really what the gold price is indicating. And I think that it is screaming a warning that not enough kind of in the mainstream crowds, I guess you could say, or mainstream kind of power centers are talking about or listening or acknowledging. This should be concerning to them. And then over here in red, I just threw the purchasing power of the dollar. This goes back to 1979. And we can just see kind of the trend when I talk about the inflationary system and the way the structure of the system is set up that requires inflation, requires a loss of purchasing power. This red line, I think, illustrates that perfectly well. And then just real quick to look at kind of how markets have digested the CPI and core CPI data. We can see that the 2-year is down, the 10-year is down marginally, the 30-year is actually flat on the day. And remember, the 2-year, this is mainly Fed expectation, interest rate, Fed, central bank, Fed interest rate expectation here. The dollar I thought was notable. The dollar initially fell and almost broke this support here that it's been trying to kind of hold on to dear life at like 98.60. It did break below that briefly and is down on the day. It'll be really interesting to see if it holds that level. Oil is rallying, VIX is down, and of course, equities really, really liked this information. This CPI beat, probably I'm sure that the expectations for Fed interest rate cuts, if you look at that, I'm sure they are now highly optimistic about more Fed cuts more soon. And I will also mention there was a story about this Fed who Trump will announce as the new Fed chair. And it was floated that Bessent, the current Treasury Secretary, would be that person. I would recommend people go, if you haven't seen it already, go watch my shadow Fed chair video. This is basically kind of what I was forecasting in that video and talking about the likelihood that we basically see kind of the shadow Fed chair, and it would work really well because he's the current Treasury Secretary. So I think that that's very telling. I would recommend people go watch that. I think that's probably where this all ends up. So anyways, hopefully that was helpful. Quick update, and I will catch you in the next one.